This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hey everyone, welcome back to my channel. In the passive income investing world, there's a term that comes up again and again, Nav Erosion. Today, we're going to break down exactly what that means and why it matters. So first, what is Nav Erosion? NAV stands for net asset value, basically, how much a fund is actually worth. Nav erosion means that even though a fund keeps paying out distributions, its underlying value keeps shrinking over time. Now, the reason so many people care about this comes down to a pretty simple dream. Park your money, collect distributions every month like rental income rolling in on autopilot. But when NAV erosion kicks in, what's actually happening is you're collecting cash with one hand, while your principal quietly bleeds out the other. And when you do the math, you might end up worse off than when you started. So how does NAV erosion happen in the first place? When you break it down, there are really three main causes. Let's go through them one by one. Let's start with a quick primer on how these high-yield ETFs actually work. Most of them generate income through a strategy called covered calls. Think of it this way. The fund holds a basket of stocks and then essentially rents out the future upside of those stocks in exchange for a premium. That premium is what funds the distributions. The trade-off is that if the stocks rally hard, the fund misses out on anything above the agreed price. Here's where the problem comes in. Early US-listed ETFs like HYLD and HYLD were running covered calls on up to 80% of their portfolio, meaning almost all of the upside was capped. Their underlying assets tracked the S&P 500 and Nasdaq 100, both of which trend upward over the long run. But the funds couldn't fully participate in those gains, so NAV kept falling behind. Modern high-yield ETFs, by contrast, tend to be more conservative. Most cap their covered call position less than 50%, leaving the other half or more of the portfolio free to ride the market higher. In a bull market, that means the fund can grow its NAV and pay out distributions at the same time, the best of both worlds. QQCL, HDIV, and HYLD are good examples of this working in practice. The fix here is straightforward. Look for ETFs with lower covered call coverage ratios so the underlying assets have room to appreciate. You'll often hear fund companies and finance content creators say that a high yield is justified by high volatility. The more a stock swings, the more premium you collect from covered calls, and the higher the distribution. That's technically true, but it's only half the story. Take Ethereum as an example. The covered call ETF built around it is ETHY, launched by purpose. Nobody questions Ethereum's volatility. It can move 20% in a single day. But zoom out over 5 years, and what you actually see is a lot of noise within a wide range, without the kind of sustained upward trend you get from something like the S&P 500. ETHY's fund structure isn't the problem. Covered call coverage is kept under 50%. The issue is the underlying asset itself. Ethereum has volatility, but it lacks long-term upward momentum. The result? ETHY currently sports an annualized yield of around 50%, but since inception, its NAV has dropped roughly 85%. Volatility alone isn't enough. The underlying asset needs a long-term upward trajectory to support sustainable distributions. The real-world situations are often more complicated than the first two cases. The Evolve Ultra Yield series is a fascinating example. A lot of people have a NAV erosion label to the lineup, but when you actually dig into the individual funds, the performance gap between them is pretty striking. The common thread across this series: they write at the money calls on about 50% of the portfolio, meaning they write options at the current market price, locking down roughly half of any potential upside. On top of that, they layer in 33% leverage to amplify returns. It sounds aggressive, and it is. The yield numbers look impressive. But here's the thing, yield is just a number. What actually matters is total return, including distributions reinvested. Let's take SCHD as an example. SCHD tracks Canada's big 6 banks with 33% leverage. When you look at total return, distributions reinvested, it comes out roughly in line with both ZEB, which tracks the same big 6 banks with no leverage or option strategy, and Bank ETF, which runs a much more modest 33% covered call coverage with 25% leverage. What that tells you is that despite carrying more aggressive positioning, SCHD hasn't been able to pull ahead on total return. And here's the concern: because SCHD is pushing out higher distributions than its peers, it has less room to preserve NAV. If the total return isn't meaningfully better, but the payout is significantly higher, something has to give, and that something is usually the fund's net asset value. When a fund's distribution target exceeds what the underlying assets can actually generate, the fund has to sell assets to make up the difference. That's Nav erosion in action. Canada's big six banks have had a relatively stable run recently with shallow pullbacks. When the underlying assets do well, there's enough headroom to cover the distributions and keep NAV intact. Now let's talk about Biggie, because this one deserves a closer look. Biggie launched in September 2025 and runs the same playbook as the rest of the Ultra Yield series. Roughly 50% covered call coverage plus 33% leverage. On paper, it sounds just like Sixy or Caney, but the outcomes have been very different, and the reason comes down to what's inside the portfolio. Biggie launched right at the peak of crypto euphoria. When putting together the underlying holdings, the fund loaded up on Strategy, better known as MicroStrategy or MSTR, and Coinbase, with the two crypto-adjacent names making up close to 20% of the portfolio. At the time, that looked like a smart call. Crypto-linked stocks are extremely volatile, which means fat premiums from covered calls, which means big distribution numbers. But here's the thing. I'm not entirely sure whether those positions were chosen purely because of high volatility, or because the fund managers genuinely believed crypto-related companies would sustain their upward momentum. Either way, the outcome was the same. What happened next, we all know. The crypto unwind came fast and hard. Bitcoin fell nearly 50% from its October 2025 peak. MSTR stock is down over 77% from its all-time high, with paper losses running into the tens of billions. And in a significant signal shift, Strategy, which had long held to a never-sell philosophy, recently sold a small amount of Bitcoin to cover a dividend payment. That move rattled confidence in MSTR even further. At this point, you can probably see where this is headed. Let's trace exactly how Biggie got into this mess. Crypto holdings falling, 33% leverage amplifying those losses, and 50% ATM covered calls continuing to push out large distributions on top of it all. The fund is getting squeezed from every direction, and NAV keeps deteriorating. While the annualized yield has been passively pushed above 40%, this creates what the industry calls a death spiral, and it's something a lot of investors don't fully appreciate. For a fund with a 10% yield, a 30% price drop only pushes the yield to around 13%. There's still a realistic path to recovery if the underlying assets bounce. But for Biggie, which was already yielding 30%, that same price drop pushes the yield to 40%, even 50%. If fund companies don't cut distributions, the spiral keeps turning. Price drops, yield spikes, the fund has to sell more assets to maintain distributions. NAV erodes further, price drops again. Which brings up an important point about Evolve specifically. The company has a well-known reputation for not cutting distributions. In normal circumstances, that's a selling point. Investors love consistency. But in Biggie's current situation, it's become a double-edged sword. Even as NAV continues to bleed, Evolve is unlikely to voluntarily reduce the payout, which means the death spiral probably keeps going, rather than being stopped in its tracks. So assuming Evolve doesn't adjust the yield, does Biggie have a path back? The conditions are tough. If crypto stages a major bull run in the next year or two and MSTR and Coin recover strongly, there's a chance NAV stabilizes. But if crypto stays range-bound, counting on the rest of the tech holdings to carry the fund is a stretch. Even 20% annual gains from large-cap tech barely make a dent against a 40% plus distribution rate. NAV erosion in that scenario is almost unavoidable. There's one more category worth discussing: funds that aren't clearly healthy or clearly broken, but sit somewhere in between. SCHD is a good example. SCHD's underlying asset is SMVP, a portfolio of high-quality large-cap U.S. stocks. Hamilton's published historical average annual return for SMVP, including dividends, is around 11%. To boost that further, SCHD adds a 25% VOO position as a leverage overlay and uses that sleeve to sell 0 DTE options that expire the same day, to collect additional premium. The goal is to hit an 18% annualized yield. Here's the question worth sitting with. If the underlying asset historically returns around 11%, can a 25% leverage overlay and 0 DTE strategy realistically and sustainably deliver 18%? That gap isn't enormous, but it's not nothing either. Personally, I think something in the 14% to 15% range would be a more conservative target, better aligned with what the underlying can actually produce. That said, in practice, SCHD's NAV has only seen a slight decline. Overall total return has been solid, and it's actually managed to outperform SMVP itself. So right now it sits in mild concern territory, not something you need to avoid immediately. One thing that works in SCHD's favor: Hamilton doesn't treat distribution stability as an ironclad rule the way Evolve does. If market conditions shift and the payout becomes harder to sustain, Hamilton has shown it's willing to adjust. Rather than grinding down NAV to keep distributions artificially high, they'd rather trim the yield and keep the fund running sustainably. That flexibility is actually a meaningful layer of downside protection. SCHD, as an ETF I hold myself, I was already aware that it might carry a mild NAV erosion tendency when I bought in. But that hasn't taken away from its overall performance. As a hedge position within a tech-heavy portfolio, it's done exactly what I needed it to do. Alright, today we covered 3 causes of NAV erosion, plus 1 fund sitting in the gray zone. Here's where I personally land on this. I'm actually fine with mild NAV erosion, as long as the fund's total return on an adjusted basis is close to, or only modestly behind, the underlying asset. At the end of the day, total return is what matters. Even if the yield is set a little high, strong total return means you can always reinvest distributions and come out ahead. So my takeaway isn't that NAV erosion is always a red flag. It's that you need to actually understand the funds you hold, know whether the distributions are sustainable, and then make a conscious choice about what to do with the income based on your own situation. Hope this was helpful. See you in the next one.